is Friday, which means it is time for Risk and Rewards, where myself and Jonathan Authers John Authers get together. I'm changing your name because I feel like it. It's that kind of week. It's that kind of year. I'm Lisa Abramowicz. But honestly, John, let's start right there. That this year has felt like a year rather than a week, which it's only been a week. And yet, what a week it's been.
Well, in terms of the stuff that we always talk about, there is a massive pivot going on in the markets in response to what we've heard from the Fed minutes. I like to think of it as like a little landmine they laid 3 weeks ago that they were going to let us know just now that they really were thinking of doing quantitative tightening sooner rather than later, just to ginger things up. We've had plenty of data that's consistent with that, and the result is that everything is that we've seen bonds break to levels that we haven't seen in 2 years. Literally, as we speak, the highest 10-year yield, the single most important yield, the highest 10-year yield in 2 years, a post-crisis high.
And so the reason why this is particularly shocking, I mean, just let's sit on that for 1 second, because here we have a Fed, and we agreed that the story of the week was the Fed pivot, which went from they were going to be patient to, oh my God, we got to get on it right now. We got to get on it faster. Yes. And oh my God, we got to add more ammunition in order to get, rates up higher and in order to tighten financial conditions. I mean, complete 180, even with Minneapolis Fed Neil Kashkari coming out and saying the balance of risks is to inflation running hotter. So the question has been, why haven't long-term rates been even higher if even the most dovish of Fed officials are saying, actually, this is a really big risk? And it seems like there has been a wake-up call, and the 10-year yield, just to give some perspective to this, okay? It ended the year at 1.5%. It's now at if you round up, 1.8%. So almost 30 basis points in just a couple trading days.
And this could conceivably very much help the Fed, because one of the things it's not been able to do, it's been a story for many years now, is that it's not been able to move the long end of the curve the way it wants to, and that's what could really have an effect on financial conditions, on inflation. I mean, the other way, if you want to look at real yields, which are a critical measure at this time, the interest first of all, to be very clear, real yields are still very negative. That is not a tight monetary policy when real yields are negative. But the rise in this year so far, this week, is the sharpest rise in 1 week since the taper tantrum, if you exclude the madness of March 2020 when the market broke down. And that's again a very, very interesting sign that there is a belief that actually the Fed could be hawkish, that there is such a thing as a Fed that doesn't blink when it sees that markets don't like what it's doing, that it might actually carry on.
So here's been the question that we keep asking all week on Bloomberg Surveillance, and I think it's a really valid question. At what point does the market turmoil become something that is concerning for the Federal Reserve, when the Fed actually comes in and decides to take some action? And then the flip side of this is the Fed trying to jawbone and sound really hawkish to tighten financial conditions so they don't actually have to do it?
I certainly think the latter is part of it. The less they actually have to do, the better for them. And I'm not going to criticize them for it. If they can get results by jawboning, that's great. I doubt how much of a result they can get from jawboning, simply because so many people believe that there will ultimately be a put. I'm inclined to think that while there probably still is a Powell put, it started out being the Greenspan put and so on, the notion that once the stock market goes below a certain level, the Fed will leap in with rate cuts to make life easier. I think the strike price of that put is much lower than it used to be. We have record stock markets, or we did a few days ago. There is room for them to fall a lot without really causing any significant pain to the broad population by a lot. I don't see why the Fed really has to stop the markets from falling more than 20-25%, whereas not always the logic, but I don't see why they should intervene until you're talking about those kinds of declines.
Well, and that's what a lot of people are saying, which is the reason why perhaps you are seeing a 50% drawdown in certain tech stocks. Why? I mean, not the overall NASDAQ, but the NASDAQ is on pace for, I believe its worst week going back to February of last year. You
Really?
know, I'm home right now, and I'm normally in the studio.
Hmm.
And the reason why I'm home is because I got Omicron. I have 2 vaccines. I'm boosted. The whole
Right.
family got Omicron. Yeah, it might be a mild illness, but it's not that mild. Like, you
Right.
actually do get sick, right? And even if you're vaccinated. And this is absolutely tearing through populations right now. You just
Yes.
came back from London and you made the observation that
Hmm.
you went from one hotspot to another.
Yes.
Congratulations on finding them all.
Yes.
And none of this is being factored in at all to markets. I mean, honestly, you can hardly find the feeling that we're still, dealing with a new wave. It's sort of, okay, maybe this is actually a good thing. Maybe it means the end of
Hmm.
the pandemic. What do you make of that? I mean, do you think that we're going to be start getting some data that indicates a greater slowdown, considering the fact that so many of us are home? And
Hmm.
it does feel like services are somewhat crimped by the fact that so
Yes.
many people are sick.
It's. I mean, it's a very tricky one. My best guess. I mean, life in London the week before Christmas was as quiet, as really lockdown type conditions, even if there wasn't a formal condition, as I have seen since the first few weeks of the lockdown here in New York, March and April of 2020. I did actually need to go into the Bloomberg office because I couldn't get access to the terminal any other way, and I had no idea it was possible. There was so much space on tube carriages and so on. I was almost on my own in tube carriages going in, which is a surreal experience if you're used to traveling around London. What I did feel, however, was that by the end of my time there, I was there for 3 weeks, people were beginning to feel as though they could live with it. In a way, British people are known for grousing and complaining. That it was an omnipresent topic of conversation, but life did just about go on. Britain did more or less have a Christmas. By the time I left, there were quite a lot of shoppers in stores and so on. There is a political row over whether to require kids to mask in schools, which strikes me as absurd. Speaking as a parent, I want them to be in school, and if masks help keep them in school, I will happily strap the mask on myself, use duct tape to all the rest of it. That's a
Parenting
very
tips by
straight
John and
trade-off.
Lisa. Take duct tape and go
Yeah,
around like this with masking. Okay, carry on.
yeah. I think, but in terms of exactly how much damage it's going to do, it's tricky because it's certainly not just a cold. I've never tested positive, luckily enough. I know plenty of people at this point who like you have had it, and it's not nothing. It's not the plague, but it's certainly something you want to avoid if you can. It's very difficult to work out exactly what this is. It's irritating. It's definitely slowing the cogs of the economy somewhat. It may well act as another inhibitor to supply. It could actually
Yeah.
be inflationary, even though it slows growth, which is an awful headache for the Fed if that's what it turns out to be. But it's plainly not back to 2020, and I don't think it's back to the worst of Delta either. But its sheer breadth, the sheer amount it messes up things a bit for so many people is new, and
Yeah.
I can't think of anything ever like it.
So, okay, given the fact that we have this health
Yeah.
uncertainty on our hands, that has
Mm,
been a health uncertainty for 2 years, but now has this added
mm,
level of uncertainty and just fervor in terms of the infection
yeah.
rates. And given the fact that we've got a Fed that has a very different mandate suddenly, or not a different mandate, but
Yeah.
perhaps a different reaction function than a
Yes.
lot of people previously had thought, I want to get your contrarian take for the rest
Yeah.
of the year, because we headed into the year
Mm,
with everyone being more bullish than their mother and their father
mm,
and their sister and their aunt or uncle. Everyone was
yeah.
trying to up their
Mm,
forecasts for year-end S&P targets.
yeah.
And it seems like it got torn up within the first 2 days for not being bullish enough. And now it's being torn up for being perhaps overly bold. And
Yes.
I'm looking at this, there is a contrarian case to be made in my mind. Do you have one as well?
Contrarian. The thing is,
Yeah.
there is so many a contrarian case to the presiding bull case as we started the year.
Or just in general, what do you think is going to happen this year?
Okay. What I think is going to happen is what I thought was going to happen quite a number of times in the post-crisis era, and it hasn't. So that's a very big caveat before we start. I continue to think that there will probably be too much inflation for the Fed not to keep hiking until it hurts. That is. Am I 100% certain that's going to happen? Definitely not. Is it my true belief that that's the single most likely outcome? Yes. And I think Omicron probably worsens the risks that we do have more inflation than we want. I think some of Bloomberg had a very interesting story about rental accommodation that vacancy rates of rental properties are now the lowest ever, like lower than they thought was possible. Like 99% of rental properties at one time are. Yeah, that suggests that we really probably should expect rental inflation to rise, and if it does, it's very hard for the overall CPI to return to anything acceptable for a while. So my best guess is that, having alerted that this was a problem for many years, this probably is the year when the Fed has to remind us it can be hawkish, and that will probably mean that stocks beat bonds, but both do relatively badly. Even if the economy itself, and even if earnings continue to be pretty good. But I've been an inflation bear or an inflation hawk or whatever animal you want to put to it for a matter of months now. It's perfectly possible I'm wrong about that, because these conditions are very, very difficult to measure. But that's my considered best guess as to where we are.
And honestly, it seems like a lot of people in the market would agree with you that seems to be the risk factor that people are trying to hedge for, which makes me think that the biggest pain trade of the year is the exact opposite. Is
Correct.
Actually, if inflation starts to slow, if that ISM manufacturing inflationary read, the prices paid earlier this week, was actually an indication of anything, showing or seeming to point toward a deceleration in inflation, does this point to a reversion to transitory? I hate to say it because I'm going to be tongue feathered, and I'm not arguing for this. I'm just saying that this would be the biggest pain trade. The Fed has a reverse course, doesn't hike rates that much. All of a sudden, big tech does fantastically. The rotation doesn't happen. All those hedge funds that just got out of tech and went into all of the consumer cyclicals and all of that get their faces ripped off, and the whole thing gets turned on its head, just like what happened last year.
Yes, I can imagine that very, very easily, because it's roughly what did happen last year. Last year, I pat myself on the back because I got, there was a big macro call last year, which I got right, which was, yes, we should be worried about inflation. And my related asset allocation call to that was, right, this means bond yields are going to go up really significantly. This is the moment they finally shoot up, get out of bonds. And that was wrong. There are many layers on this, and the reason that again, there are, Godot doesn't arrive. People talk about, and Lucy never lets Charlie kick the football, but that doesn't mean that there isn't some world in which Godot does show up and Lucy does, some other little girl does let Charlie Brown hit the football. I am very nervous because I feel like Charlie Brown always being nervous about a rise in bond yields, and it doesn't happen. But it could. It doesn't mean that it can't ever happen. So anyway, that's where I stand.
I like that. Lucy always takes the football away. But what if she doesn't? No, but in all honesty, and unfortunately we are at a time, but this does to me highlight sort of the conundrum for a lot of traders. They've seen this movie so many times before, and this one feels different. Yet they've seen this movie so many times before. And so how do you set up in an environment that seems unprecedented and feels a little bit different, yet given the past experience, which is always the same? Yes. So, again, this is sort of the push-pull. We'll pick it up again next week. Hopefully I will be back in studio. Yes. And
get well soon, Lisa.